I'm joined today by Lonwabo Maqubela, who's Deputy Chief Investment Officer at Perpetua. Lonwabo, welcome to the channel.
Thank you, Chris, and thank you for having me.
My pleasure. Lonwabo, if you can maybe give us just a snapshot of the kind of global and domestic market, what's the outlook, what's happening?
Yeah, we can do so, Chris. I think what we've seen, particularly last year, with U.S. inflation coming under control, is that markets had a significant rally. So they were actually up some 30% from the October lows.
Right.
So quite a big rally, mostly driven by technology, as everybody knows. But nonetheless, the S&P is trading 25 times plus earnings, when normal is typically around 18. So significant overvaluation. The market got itself, I would say, what got the market excited? I would say, the perception that inflation is coming under control. It's not yet under control. Often, historically, we found in the past that once inflation rears its ugly head, tends to be an unwelcome visitor and stays a bit longer than expected. But it is coming under control. But often what happens is, in order to get inflation to come under control, central banks have to take corrective action, significant corrective action, and that typically results in some kind of a recession or slowdown. So whilst the market's excited about inflation coming under control, what we're certainly seeing is that the growth outlook has deteriorated. When one looks at all the leading indicators, so the likes, credit card advances are slowing. Home prices have fallen the fastest that they have historically in the US. The only other time that they've fallen faster was during the global financial crisis. Defaults are rising, both in commercial and personal. So we're definitely seeing the signs that there's something more than a soft landing that's happening, that's not being discounted by the market. I think over the last decade, we all got spoiled by China. So China did a lot of the heavy lifting. And what we think about Chinese growth going forward is that quite a lot of the growth was debt funded and debt fueled. And they've become a lot more circumspect around, some of the excesses that took place in that market. And so, they've as much as every now and again, they will announce a stimulus. The size of the stimulus are not quite as big as they used to be in the past. And so we think that the growth outlook for China is also a bit muted. We think in Europe, actually, there's signs that inflation is coming under control. We're starting to see some countries cutting rates. So we think they might actually be at the beginning of some kind of improving growth profile. South Africa, obviously, South Africa has been a challenged country for probably the last decade or so. And a lot of the policy reforms that everybody was hoping for haven't really taken root. So it's actually very easy to highlight the negatives in South Africa. So I often try to stay clear from them. But what I would say, the one positive, that and actually what tends to matter for investors is inflation. So some studies have been done seeking to answer the question, typically what happens to asset class returns when economic growth is low, high, or middle, right? And the reality is that so long as inflation is under control, what tends to happen is that asset class returns tend to be okay. So even if you have low growth, but with no inflation, asset class returns tend to be okay. And so the message we've been sending, to our clients is that for all the errors that happen in South Africa, the one thing we've gotten right is that our central bank is singularly focused, on inflation.
Right.
And we think that will bode well, actually, going forward, given where valuations are. So what are we doing in our funds, given this macro backdrop that I've just spoken about? So we have taken, so in some of our balanced funds that can invest in cash and fixed income, we historically had a much lower asset allocation towards equities than our peers. Actually, in recent months, we did increase it, but that's really because we bought some gold equities, so to actually increase the level of protection in the fund. So I guess in a way you could say we remain more conservative. We have quite a lot of consumer staples, so typically businesses that are more defensive than average, which will tend to do well in downturns. We are underweight US tech. So yes, it's been painful being underweight, I guess, the sector that has been trending, but we think the valuations, notwithstanding the growth, don't make sense. And we're able to find more attractively priced equities. So for example, short US tech, but long Chinese tech. So the likes of Tencent, which are still trading on very undemanding multiples. We also have noted a shift in the tone by the Chinese regulators who have become a lot less draconian than they were during the regulatory crackdown. So that we think that's a positive. And then domestically, the domestic market, we think that, it will be a much more of a stock pickers market. Often where outperformance comes from as a fund manager comes from your asset allocation to a sector, and it comes from your stock picking. Now, what we're finding is that there's the whole market, in essence, I could say that the whole market is undervalued. So we think there's not going to be significant differences that are going to arise because of your sectoral exposure,
right,
on a 4 or 5 year time horizon. In the short term, yes, they can. And so we think what's really going to be the driver of returns for investors over and above the benchmark will then be stock picking. We think that this favors investors like ourselves that are more fundamentally based and do bottom up work.
100%. I'd love us to maybe re-engage a little bit going forward and just check back from time to time. It's been an absolute delight having you on the show. So thank you very much. And
thank you, Chris. That was a pleasure doing it as well. Thanks very much.
Bye.